Investment in macroeconomics refers to the purchase of new capital goods, such as machinery, equipment, and buildings, as well as changes in business inventories. It is a crucial component of aggregate demand and a key driver of long-term economic growth and development. Types of investment in macroeconomics. From a macroeconomic perspective, we can broadly categorize investment into the following types. Fixed investment. This refers to spending by firms on new capital goods that are expected to last for more than 1 year. It can be further divided into business fixed investment, purchase of new machinery, equipment, software, and non-residential structures, factories, offices, etc., by firms. This is often considered the most volatile component of aggregate demand. Residential investment, spending on new housing units by households and landlords. Inventory investment. This involves changes in the stock of goods held by businesses. It can be positive when firms produce more than they sell, leading to an increase in inventories, or negative when firms sell more than they produce, leading to a decrease in inventories. Inventory investment plays a significant role in short-run fluctuations in GDP. Another important distinction is between autonomous investment. This type of investment is independent of the current level of national income. It is often driven by factors like technological advancements, government policies, or long-term expectations about future profitability. Induced investment. This type of investment depends on the current and expected future levels of national income and aggregate demand. Higher income and demand tend to encourage firms to invest more to expand capacity. Determining factors of investment. Several factors influence the level of investment in an economy. Interest rates. Interest rates represent the cost of borrowing funds for investment. Higher interest rates make investment projects more expensive, thus discouraging investment. There is generally an inverse relationship between interest rates and investment. Expected rate of profit, marginal efficiency of capital (MEC). Firms invest when they expect the return on their investment to be higher than the cost of financing it. Expectations about future demand, technological advancements, and the overall business environment significantly influence the expected rate of profit. National income, GDP, and aggregate demand. Higher current and expected future national income and aggregate demand tend to boost firms' confidence and create a need for increased capacity, leading to higher induced investment. Business confidence and expectations. The overall sentiment and optimism of businesses about the future economic outlook play a crucial role in their investment decisions. Uncertainty or pessimism can lead to lower investment. Technological advancements. New technologies often create opportunities for profitable investments in new equipment and processes, driving autonomous investment. Government policies. Fiscal policies such as tax incentives, subsidies, and investment allowances can encourage investment. Monetary policies influencing interest rates also have a significant impact. Regulations and political stability also play a role. Availability of finance. The ease with which firms can access funds, through borrowing or retained earnings, affects their ability to invest. Capital stock adjustment. Firms invest to adjust their existing capital stock to the desired level. If the current capital stock is below the optimal level needed to meet expected demand, firms will invest to close the gap. Inflation. High and volatile inflation can create uncertainty and discourage investment due to difficulties in predicting future costs and revenues. Investment and economic growth and development. Investment is a fundamental driver of macroeconomic growth and development, but its impact is not always a straightforward boom. Here's a nuanced perspective. Positive impacts. Increased aggregate demand. In the short run, investment spending directly adds to aggregate demand, leading to higher output and employment through the multiplier effect. Capital accumulation. Investment increases the stock of capital goods in an economy. A larger capital stock enhances the productive capacity of the economy, allowing for the production of more goods and services in the future. Improved productivity. Investment in new and better capital goods often embodies technological progress, leading to higher labor productivity, more output per worker, and overall efficiency, total factor productivity. Technological innovation and diffusion. Investment is often the channel through which new technologies are adopted and spread throughout the economy, fostering innovation and long-term growth. Infrastructure development. Investment in infrastructure, roads, communication networks, energy facilities, is crucial for supporting economic activity, reducing transaction costs, and attracting further investment. Long-run economic growth. By increasing productive capacity and efficiency, sustained investment is essential for achieving long-run economic growth and higher living standards. Job creation. While some investments might automate tasks, overall economic growth spurred by investment tends to create new job opportunities in various sectors. Not always just a boom. Short-run volatility. Investment is often the most volatile component of aggregate demand. Sharp swings in investment can contribute to business cycle fluctuations, leading to periods of boom and bust. Crowding out. In certain situations, particularly when the economy is operating near full capacity, increased government investment financed by borrowing can lead to higher interest rates, potentially crowding out private investment. Opportunity cost. Investment involves foregoing current consumption. The resources used for investment could have been used for other purposes in the short run. Gestational lags. Investments often have a time lag between the initial expenditure and the resulting increase in productive capacity and output. This means the benefits of investment might not be immediately apparent. Misallocation of investment. If investment is directed towards unproductive or inefficient sectors due to market distortions or policy failures, it may not contribute effectively to long-term growth. Depreciation and obsolescence. Capital goods wear out or become outdated over time. A certain level of investment is needed just to replace depreciated capital and maintain the existing productive capacity. Net investment. Gross investment minus depreciation is the key driver of capital stock growth. Impact on income distribution. The benefits of investment-led growth may not be evenly distributed across the population, potentially leading to increased income inequality if not accompanied by appropriate policies. In conclusion, investment is a critical engine for macroeconomic growth and development. It expands productive capacity, fosters innovation, and boosts aggregate demand. However, its impact is complex and can be influenced by various factors. Policymakers aim to create a stable and favorable investment climate to maximize its long-run benefits while mitigating potential short-run volatility and ensuring that the gains from investment are widely shared.